Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hemoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're discussing a new forecast from the National Bank of Canada that suggests the Bank of Canada may hike interest rates in 2026. This prediction comes just as many Canadians were hopeful that the era of rising rates was behind us. In its latest forecast, National Bank of Canada is anticipating a reduction in the Bank of Canada's policy rate by 100 basis points to 2.25% this year. This reduction is expected to be temporary, with an increase of 50 basis points predicted for 2026. National Bank economist Tyler Schleich explained to Canadian Mortgage Trends that the anticipated rate hikes are expected to follow a phase where the Bank of Canada will lower its policy rate slightly below neutral to stimulate economic activity. Although Canada is not in a recession, the country's GDP growth has been below its potential for some time. Schleich suggests that a period of GDP growth above potential is needed to return the economy to equilibrium, which is why they forecast a year with the policy rate at 2.25%. The National Bank's prediction stands out among the big six banks, as others like Scotiabank expect the Bank of Canada to maintain a higher policy rate of 3.00% through 2025 and 2026. Meanwhile, TD Bank, Canadian Imperial Bank of Commerce, Bank of Montreal, and Royal Bank of Canada foresee continued rate reductions this year, but none have yet indicated rate hikes in their long-term forecasts. The forecast by National Bank also considers the significant number of mortgage renewals set to occur in 2025 and 2026. Approximately 60% of outstanding mortgages are expected to renew during this period, many of which are 5-year fixed-rate mortgages, initially issued during the housing boom of late 2020 and early 2021, when rates were at historic lows. The Bank of Canada's research suggests that 60% of those with mortgage renewals in the next 2 years will experience payment increases. Schleich highlighted that a temporarily lower Bank of Canada policy rate could help ease the transition for those facing mortgage renewals. The timing of the potential rate hikes, according to National Bank, is set to occur after the significant refinancing window has passed, thereby minimizing financial stress on borrowers. Moreover, National Bank argues that cutting the policy rate to 2.25% will be necessary to support not only the below-potential economic growth, but also to address ongoing slack in the labor market. With job growth expected to lag behind population growth, National Bank forecasts that the national unemployment rate will rise to 7%, up from its current level of 6.7%. Let's turn our attention to a pressing issue in Ontario's housing market that has been making headlines recently. There's a growing call for immediate reform of the province's taxation and fee structures related to new residential construction. The current system, with its high sales taxes, fees, and particularly development charges, is being described as out of control, significantly contributing to the unaffordability of homes for many Ontarians. According to Richard Lyle, who wrote a detailed piece on this issue, these financial burdens are self-inflicted wounds that are pushing working individuals and families out of their communities. The tax burden on a newly constructed home in Ontario has escalated to almost 36% of the purchase price, up from 31% just 3 years ago. This increase has been linked to a report by the Canadian Centre for Economic Analysis, which notes that with the average price of a new home in Ontario at approximately $1,070,000, consumers are now paying around $381,000 in various taxes and fees. Development charges, which municipalities impose on developers to cover infrastructure costs like roads and water treatment plants, are a significant part of this burden. Although developers pay these charges up front, they ultimately pass these costs on to home buyers, further inflating housing prices. In the Greater Toronto Area, excluding Toronto itself, the average tax and fee burden on a new home is 35.9%. In Toronto, it's slightly lower at 35.1%, but still a substantial portion of the cost. These charges are exacerbating the housing crisis by making it financially unfeasible for developers to invest in new projects. The federal government has made some efforts to address this issue, such as removing the 5% goods and services tax on new rental apartment buildings. Similarly, Ontario has announced plans to remove the 8% sales tax on qualifying purpose-built rental housing. Political leaders are also weighing in with their proposals. Federal opposition leader Pierre Poilievre has promised to eliminate the federal sales tax on new homes sold for under $1 million. Ontario. Liberal leader Bonnie Crombie has pledged to remove the provincial land transfer tax for first-time homebuyers if elected. There's now a call for the provincial Conservatives to take similar actions to alleviate the financial strain on homebuyers and encourage more affordable housing development. A study by economist Mike Moffat highlighted that over the past 4 years, more than 100,000 more people have left Ontario for other provinces than have moved in. Development charges are cited as a major factor in this exodus due to their impact on housing costs. A 2022 study by the Canadian Home Builders Association found that Toronto has the highest development charges nationwide at $85 per square foot. To put it in perspective, the development charge for a single-family home in Toronto was $141,139 as of September, marking a staggering 993% increase from 2010. With housing starts in Ontario projected to be around 81,000 for 2024, falling short of the government's target of 125,000, there's an urgent need for reform to meet the goal of 1.5 million homes by 2031. The consensus among experts is clear. Senior levels of government need to play a larger role in funding public infrastructure at the local level, thereby reducing the reliance on development charges. Municipalities often lack the revenue streams to fund necessary infrastructure, resulting in these costs being transferred to new homeowners. It's essential to move beyond temporary fixes and implement comprehensive reform of the taxation and fee structures affecting new housing development in Ontario. Ontario's financial services regulator, the Financial Services Regulatory Authority, has imposed administrative penalties totaling $20,000 against Patricia Perretta. This action comes as a result of Perretta providing false and deceptive information in mortgage dealings, which violates Section 43, subsection 2, of the Mortgage Brokerages, Lenders and Administrators Act, 2006. Additionally, Perretta engaged in mortgage dealings for remuneration without acting on behalf of a licensed mortgage brokerage and without being exempt from the licensing requirement, contrary to Section 2, subsection 3, of the Act. Patricia Perretta sought a hearing before the Financial Services Tribunal to contest the penalties. However, she did not adhere to the schedule set by the tribunal. Consequently, the tribunal dismissed her request for hearing and ordered the Financial Services Regulatory Authority to proceed with its enforcement action. The tribunal's decision outlines the reasons for dismissing her request. This case highlights the Financial Services Regulatory Authority's commitment to protecting consumers by ensuring compliance with regulatory standards. By imposing these penalties, the authority aims to deter similar violations in the future and maintain the integrity of Ontario's financial services sector. For those interested in learning more about this case and other enforcement actions, the Financial Services Regulatory Authority provides access to an enforcement database. This resource allows stakeholders to see how the authority is actively monitoring and enforcing compliance to safeguard consumer interests. In today's currency markets, the Canadian dollar has edged up slightly against the United States dollar. This comes as new data on United States producer prices offers some support to investors who are betting that the Federal Reserve may continue its easing campaign later this year. As of now, the loonie is trading 0.1% higher at 1.4365 to the United States dollar, or 69.61 United States cents, having moved within a range of 1.4344 to 1.4410. The Canadian dollar has been relatively stable after previously hitting a near 5-year low at 1.4467 last December. However, potential trade tariffs from the United States and a hawkish stance by the Federal Reserve have kept any significant rallies for the loonie in check. Darren Richardson, the chief operating officer at Richardson International Currency Exchange, mentioned that softer than expected inflation figures in the United States might give traders some breathing room as they anticipate the Federal Reserve might cut rates later this year. The United States dollar has given back some recent gains against a basket of major currencies, after United States producer prices rose less than forecast in December. Additionally, there are reports suggesting that the United States may adopt a measured approach to expected tariffs on major trading partners. Meanwhile, President-elect Donald Trump has expressed intentions to impose a 25% tariff on Canadian goods and has even suggested making Canada the 51st state. In response, Canadian Prime Minister Justin Trudeau is planning a cabinet retreat later this month to focus on defending Canada's interests and strengthening ties with the United States. Oil prices, which are a significant part of Canada's export economy, settled 1.7% lower at $77.50 a barrel, following a forecast of steady United States oil demand in 2025. Additionally, Canadian bond yields have risen across a steeper curve, with the 10-year yield up 3.8 basis points at 3.545%, after reaching its highest level since early July at 3.569%. As we see these developments unfold, it's crucial to keep an eye on how these economic factors will influence the mortgage and real estate markets in Ontario and across Canada. Currency fluctuations, trade policies, and interest rates all play a role in shaping the broader economic landscape, impacting everything from home prices to borrowing costs.